Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. I'm joined today by Todd McGarity, Equity Strategist at Polaris, and we'd like to discuss a couple of different headlines that are going through the news before we get into some investment themes and some ideas for your portfolio. So first and foremost, last week we had Bernanke speaking to Congress in his semi-annual address to Congress about monetary policy, and he of course is talking about the sort of the same themes that we've been seeing all along, quantitative easing, etc. What were some of the key points of that discussion? What are your takeaways?
Well, I think some of the key points were obviously he's trying to manage, it's a very difficult balance right now. He's trying to manage an eventual increase in rates.
Let me pull up that chart actually while we're talking about it here.
What you've seen here is that in the first commentary when he came out and said that there would be no easing anytime soon, the speech before, you could see that that rates kind of responded.
Right here, I need to get out of the way.
So you could see this dip. Rates responded by falling pretty sharply. And then what we've seen now is a rally back to that trend line, which you can see here on the chart. So this latest speech, I think the goal was pretty much to manage the economy or manage expectations about the economy and interest rates and this QE program.
It was definitely a lot more dovish than it was in the past. He definitely seemed like he was going to be managing to keep rates at that lower level for a longer period of time.
Absolutely.
It did seem that way.
And like I said, this is a delicate balance between stepping on the gas to fuel the economy and also sending a signal that you're ready to step on the brake if it gets too hot.
Exactly. And something that we talk about here, and this is sort of the second headline, something that we talk about here in Hilton Head, and I guess in every location, is real estate. And one thing that we've seen from this is that real estate is starting to rebound. People are starting to feel wealthier. And that second headline that we've seen a lot more evidence of is the so-called wealth effect. So talk to me a little bit about that.
Well, I think the Fed is watching some of these leading indicators pretty closely. Real estate sales, and I think is the big jump that we've seen here. Obviously, as a result, some can be written off by the sharp increase in rates. I think we've seen the low for interest rates or on the long end of the curve. I think we've seen the lowest mortgage rates that we're going to see. It
is interesting though. You hear a lot of commentary of really trying to go out and sell still as interest rates are going up. They're still historically, if we can go back to it, so low that you're still, you're hearing a lot of commentators, a lot of analysts saying, okay, yes, interest rates might be increasing gradually, we might see an increase at the long end of the curve, but it's still cheap.
That's exactly right, but nothing, spurs a purchaser or a purchase of a home like saying, hey, rates are going to move up on you.
Well, the second thing that would spur it, I think, is probably their portfolios going up.
That's exactly right. You've got a wealth effect that people are seeing on paper. We've had a great year in the market so far, and I think it's going to continue.
It's scary to think, history repeating itself back from, I don't even want to say it. Okay, so those are our two headlines, and then the third headline that we wanted to discuss is that in spite of the wealth effect, in spite of sort of this, continued growth in the economy, we are still seeing some negative numbers, just to sort of play devil's advocate on the whole thing. We did see some weak retail sales last week. We had some weak numbers this week. What are the implications of that?
Well, we did see weak retail sales this past time, but keep in mind that retail sales are really a lagging indicator, so the Fed doesn't watch that as much as it does future numbers, because the market always trades on a future expectation.
What does it say about the consumer though? Does it say that the consumer is saving more? Does it say that there's still an overall unease in the economy, or what is that saying?
Well, I think we're in the middle of a pretty strong bull market. We're now, 4 years into a bull market, and I think for most people, there's still a lot of unease out there. It's 2007 still rings pretty loud in people's mind.
It is interesting because it does seem like this bull market, the 4 years bull market that we've had, it doesn't seem to be impacting each segment of the economy equally, and certainly different generations, different economic sectors are definitely getting impacted differently. So these numbers are sort of all over the place as a result of that.
Right, that's exactly right. I think I think if you are looking at lagging indicators like retail sales, you're going to be misled, because by the time those start to improve, the market's going to already make that move. So, and I think the bond market right now is specifically telling you that the economy is getting stronger and will continue to.
Interesting. All right, well, we'll be back in just a second. We're going to take a couple of minutes to explain a few of the dynamics that we see going on, and then we'll be back in a few minutes to talk about ideas for investing your money going forward. Please stick with us. This is Money Matters. Welcome back to Money Matters. Before we keep going, just keep going. Welcome back to Money Matters. I'd like to discuss two commonly misunderstood topics, one that we started to address in the first part of the show and one that we're going to address when we get into investing ideas in the next segment. So these two topics, the first is tapering. Everybody has heard tapering out in the news. What is tapering and what are the implications for the economy? Before we talk about tapering, let's talk about what easing is, because they're all related here. So Federal Reserve easing is basically the Federal Reserve buying treasuries and mortgage-backed securities, and when they buy those securities, they're pumping money into the economy. By pumping money into the economy, it's supposed to stimulate growth. It also is intended to keep interest rates low and therefore to stimulate growth. So that is what easing is. That's what we have seen for the last several years, as you can see here, starting back in late 2009, early 2010, is when the Fed started easing and started pumping more money into the economy. We've had 3 different rounds of that. The opposite of that, which of course happened years and years ago, is what's called tightening. Tightening is the opposite of easing. Instead of pumping money into the economy, the Fed is pulling money out of the economy, and the way that they do that is selling securities. So they're selling securities into the economy or into the public, and therefore taking money out of the economy and trying to tighten monies in the economy. So what people are somewhat, I think, misunderstanding is when we're talking about tapering, we're not talking about tightening. It's not the same thing. Tightening, as we talked about, is the opposite of easing. Tapering is actually reducing the amount of quantitative easing in the economy. So right now, Ben Bernanke and his cohorts in the Fed are pumping about $85 billion into the economy on a monthly basis. Tapering would be reducing that amount, perhaps at a regular rate, perhaps at an uneven rate, but would be reducing that amount. So it would still be pumping funds into the economy, but it would be doing it at a slower rate, eventually, hopefully, getting back to a zero. But right now, that's still what's in discussion. So it's not tightening, and people don't need to panic about the fact that this might actually be a reversal of quantitative easing. It's actually just a reduction in the amount of funds that are being pumped into the economy. Still stimulative, but somewhat less stimulative than it has been for the last 3 years or so. It's actually a sign of overall health in the economy, hopefully. So when we start to see that tapering occur, it's not something to run and panic about. It's actually usually, it should be stimulated by good economic news. So that's the first topic that I wanted to talk about. The second is actually covered calls. And this is something that we're going to talk about more in the third portion of this segment when we talk about ways that you can generate income. But this is a very commonly misunderstood topic. I want to talk about what a covered call is. When people hear calls, they think options. When they think options, they think risk. Covered calls are basically the opposite of that. They are not, they are the least risky of all options positions that are out there. So what is a covered call? A call is basically giving somebody or selling somebody the right to purchase a security from you at a set price at some time in the future. So the factors that we're looking at here, let's say hypothetically, we have a stock that is valued at $70. XYZ stock is valued at $70 today in the market. I am going to go out into the market and I am going to sell someone the right to purchase that stock from me at $75 at some point in the future, call it 1 month out. So the strike price is the $75, that's what we're looking at. 1 month out is our expiration date. And then I'm just going to sit back. Now that I've sold that call and I've received a premium for that call, that premium, it could be 50 cents, it could be $1 per share. That premium is pocketed on the day that you actually sell the call. Then you sit back and you wait until, or you don't necessarily sit back, that's not what a portfolio manager does, but hypothetically, you sit back and you wait to see how the market is going to respond over the next coming weeks until the call expires. So between now and a month from now, chances are that stock price will move and will ebb and flow. It could go down, it could go up. If the stock price actually exceeds $75 per share, which is our strike price, then we will get called out, or the person that we sold the right to purchase that stock from us to will call our stock, will take our stock away from us. That's not necessarily a bad thing, because we as the owner of the stock have actually pocketed the gain between 70 and 75, as well as the premium income that we gain from selling the stock into the open market. I'm sorry, from selling the call into the open market. So it's actually, that's a positive. If, however, the stock price does not exceed 75 and goes down or stays within the range of 70 to 75, then we usually wind up continuing to hold our stock at that time. We keep the premium income that we receive for selling the call at an earlier time, and we continue to hold our stock. After that maturity or after that expiration date, we can then go back out into the market and sell yet another call. Now, you still have downside exposure because you still own the stock. So if the stock goes down, it goes down just like it would if you had not sold the call out into the open market. But because you've received premium income, and again, let's call it 50 cents or $1 per share when you sold that call, your downside is actually somewhat reduced because let's say, for example, the particular stock goes down $5 and I've received $1 in income. Then my net loss is only $4. So it's actually less than the person who just owned the stock outright without having sold the call. So as a result of that, as a result of the combination of these factors, you're actually reducing your overall portfolio risk because you're bringing in additional income to buoy any losses that you might have in that stock. In addition to that, and what we're going to talk about in the third portion of this show, is the benefit of doing this is that you can actually bring in additional income into your portfolio on existing securities that you would have held anyway, that you wanted to hold because they're just good investments. It's a way to increase income at a time when we have extremely low interest rates, and therefore it can be difficult to find ways to achieve higher income in this market. So just an idea that, or just a concept that I wanted to cover because it's commonly misunderstood, frequently tied to risk, when actually what we're looking to do here is reduce risk and generate income. So we're going to discuss more of these ideas in the third portion of the show, but I wanted to go ahead and clarify that point before we dug into it in theory. So thanks for sticking with us. We'll be right back in a second with investment ideas for your portfolio. This is Money Matters. God, did I suck on that one? Okay. Back to Money Matters. I'm again joined by Todd McGarity, Equity Portfolio Strategist at Polaris Capital Advisors, so that we can talk about some ideas that we see in the market right now for investing in your funds. So Todd, we've talked about a couple of the various themes that we've continued to talk about for the last couple of years.
Right.
Let's talk specifically right now about income investors, those that are actually trying to pull income off of their portfolio. What is your first recommendation that you have?
Well, they've certainly had a tough go at it here in the last several years with the Fed easing and bringing rates way down. What they're trying to do at that point is force money into the market or in paper assets, because we talked about the wealth effect a little earlier, right? So
if you're making this kind of income off of it 20 years ago, and
that's
then
exactly right. We've seen
a
steady decline in rates, and now it's gotten to a point where rates are so low, artificially low.
It's harming savers.
It's starting to harm people who are saving, so they are trying to force that money out into the economy for, I guess, the greater good of the whole economy. So, as far as recommendations go, there's several different things, and I think you touched on it in the last segment a little bit on covered calls. This is a this is a method we've used for quite a while, as you know, to garner some income for people who are starting to really hurt from a savings standpoint.
And talk to me about that for a second. I'll flip back to that chart, but with I briefly talked about the fact that when you sell a call into the market, you generate a premium income. So when you're doing this, not just theoretically, like when we're looking at this chart, when you're doing this, how frequently do you actually sell those calls? And what additional percentage income do you feel you can actually generate on top of your standard dividends?
Well, the options market overall has grown by leaps and bounds here over the last 10 to 15 years.
That's a whole other topic in and of itself.
Right. We used to have just monthly expiration of options pretty much. Now you can write options on ETFs, which we do quite often, and you can even write them on a weekly basis. So there's all sorts of ways if you want to micromanage the move in the stock, meaning you don't want to have 30 days of time to wait
right.
Before, giving you a little more time.
Well, let's
risk.
talk about that for a second, because I think that's something interesting for people to understand is the premium income that you receive when you sell a call into the market
Right.
is based on a lot of factors. One, of course, is going to be volatility, but the other is what you just mentioned, time value.
That's exactly right. A lot of times when you're writing out of the money, that's what it is time value, since there is no intrinsic value in it. So what we like to do is, in a perfect scenario, we're always writing at a higher strike price.
Just like we're showing here, where the market's at 70 and the strike price is at 75.
That's right. That's assuming whatever you're holding there has got to be a pretty stable value. Now, you're not going to get as much premium, but we never buy stock just for volatility reasons, just to get more premium income.
Right. I think the basic premise here is that you hold a portfolio based on stocks and companies that you believe in, or trends that you believe in if you're looking more at an ETF
That's exactly right.
standpoint. And this is a way to increase the income that comes from that portfolio.
Right. What you talked about is reducing risk and also getting income from people who are holding, individual stocks that they may have been holding for a long time. They still are comfortable with those stocks, especially if they're blue chips. But it is a way to almost, push the return of the overall portfolio up a little bit, and to hedge your risk a little, and maybe pull some income off those stocks and supplement some of the income that they're not getting from their fixed income side.
Now, your standard income that you're going to be pulling from this, however, like let's compare a couple of different securities. So, for example, Microsoft.
Right.
Here's Microsoft, a stalwart, steady company. Blue chip type company. The kind of premium income that you can generate from a Microsoft these days, especially in a relatively low volatility world, is a lot smaller than other securities, say. So, and yet, talk to me about some of the ones that you're using to generate additional income, or where you're seeing more of that.
Right. Well, in theory anyway, if somebody's going to own some stocks, and it depends obviously on their age and risk tolerance, but usually we're going to have some stocks in there that are a little more volatile, than your standard blue chip. Maybe they have some small caps in there just for overall diversification. So some of those can be used to garner a little more premium income, especially if they've got some securities in there that they've held for a long time that they don't want to sell for tax reasons.
So often, that's another good point. So actually, let's get back to that in just a second. But so oftentimes, companies that have big dividends probably don't have significant premium income that
That's
can come
exactly
from
right, because of that dividend obviously, decreases the volatility a little bit, because of the stability of the stock and that they pay out most of those earnings.
So you're really looking at doing more of this with more of either your smaller mid-cap stocks, I guess, or your indexes like ETFs.
Exactly. This is one thing that's totally changed the industry is the weekly options or monthly options on ETFs. So if we have a trend that we've been following, I don't know if you've got that interest rate chart back up.
I can find it again. I'm not so good at this.
And if people who have watched the show before know, we've been talking about this for the last couple of years. We have been short treasuries, for the last couple of years. Well, no, it's now we're starting to really get paid handsomely for it.
Right.
And we believe we've seen the bottom in rates, that we're going to see nothing but higher rates as it moves forward. The bond market's telling you that it's breaking a 30-year downtrend in rates.
But the trend that you're talking about can actually be tracked with an ETF.
That's exactly right.
And that ETF can actually generate pretty substantial premium income.
Because rates and bond prices move inversely of each other, what we've got is a short Treasury ETF, meaning we believe the value of those treasuries is going to move down and rates move up. So we can go out on the yield curve somewhere between 20 and 30 years using an ETF. And while we're waiting on this trend to reverse, because once it gives the indication that it's reversed, you talked a little bit about the Fed,
easing, tightening, tapering.
or tapering versus, is just letting off the accelerator a little bit. But the bond market's always going to look forward, and the easing or tapering of that easing is the first, sign, and that's the beginning of going back in the other direction, which is tightening.
Well,
so that's all the bond market needs to see.
Right.
And therefore we are definitely long because of the strength in the economy and because of the eventual end of this the Fed's quantitative easing program. You will see higher rates, moving forward. So we can play that trend by writing covered calls on that short Treasury ETF and actually get income if we want to. For some people, we're writing it on a weekly basis. For some, we write it on a monthly basis and write it further out of the money.
What I think is really worth pointing out here is, we started this segment, we were talking about income investors. And what, the investments that we're talking about right now are not your blue chip, your Microsoft, your IBMs with the 3-4% dividends. We're talking more about growth-related securities that probably will perform better in the coming months than perhaps some of the blue chips as interest rates go up, but ways that you can actually generate income off of growth-oriented securities. It's a little counterintuitive.
Well, you bring up a good point about the big dividend payers. A lot of the prices on those big dividend payers, because people were chasing yield that way, a lot of them have been run up, to probably artificially high levels.
Exactly.
So your dividend yield is lower, but it's still better than you could get, in standard treasury market.
For now.
Those sorts of securities, as rates start back the other way, people need to be, very aware and very careful about stocks that are that have been notorious high dividend payers, utilities, things of those sorts.
Evidence the other day, or I guess it was a couple weeks ago, when Ben Bernanke came out and said, when he didn't announce tapering, but people were led to believe that there could be tapering, and the market just tanked.
That's right.
Because if interest rates go up, then there's not as much value in those high dividend yielding stocks as there was. It's artificial value that's there.
And a large part of those make up the actual indexes like the Dow. So, but yeah, that's an important point to remember for people out there. If you do have securities that have been run up because they were dividend payers, or a basket of utilities, this might be a time to look to reallocate your portfolio, because we believe that rates are moving up higher, and you will get hurt that way.
So we don't just need to look to bonds like we've been saying for the last several years as far as things to remove from your portfolio, but definitely look at an overallocation to high dividend yielding stocks, perhaps even moving to growth. But again, if we're looking for ways to generate income from growth-oriented securities, this is one way to do it. A little bit complicated. I'm sure a lot of people gloss over when we start talking about this and the charts and everything, but it's one great way to increase portfolio income and also reduce overall portfolio risk.
That's right.
Awesome. Well, thank you very much for joining us today. I really appreciate it.
Thanks.
Hopefully I'll have you back soon. Thank you for joining us today. We appreciate your tuning into our show. Please check us out on Facebook at Money Matters/Poeras. Please give us a call with any of your ideas. We love hearing them. We love your questions. So check us out at any time. Give us a call. Look forward to seeing you next week here on Money Matters.